Okay, well, that's of course, Dr. Mishra from San Hospital. He puts in his sweat and blood when it comes to making investments. He's reading up a lot. He makes time to do all of this. But now I understand that not many of you may have the bandwidth to be able to incorporate yet another completely new subject into your already busy schedules as healthcare workers. And that's the reason why we decided to also bring on board the masters who've already, specialized in this. So here's welcoming on the show Harshvardhan Roongta of Roongta Securities. Harsh, a pleasure having you with us today on the Money Show. We were just having a conversation with Dr. Prashant Mishra, it being National Doctors Day. Dr. Mishra's story is a very interesting one. He decided to hone his skills as a stock picker, as a Dalal Street investor. However, of course, I would say that unfortunately Dr. Mishra is an exception. He's really sharpened his skills on stock picking and stock selection quite a bit. Harsh, is that the path of direct stock investing that you would recommend our nation's healthcare workers start off on when it comes to their investments?
Well, Mubina, the question that you're very clearly asking is whether a person, a healthcare worker who's starting off, can he or she start picking up stocks directly from the stock market? So, well, if you have the competency, then why not? I mean, the question is whether you have the competency or not. It's not whether you believe that you have it or not. Now, there's a difference that I'm trying to say. Many people believe that they are very good at stock picking, and in a bull phase, we have very good stock pickers because everything seems to be working. So, if you buy any stock, and if it's going up, you tend to give credit to your stock selection process. However, that may not be true. So, coming into the typical career graph of a doctor or a frontline health worker, you will see the career actually picks up. The earnings really start, post their 30 years of age. Until then, they are, specializing into some field. They are, constantly doing some kind of, studying. And, the real income starts beyond 30 and 35. So, that is a time when you have sufficient amount of money in your hand to invest. The question we come back to is that what do you do until then when you're earning a stipend or you're already getting some bit of income which is good enough but may not be really surplus in nature because you're still not a professional or a specialized surgeon kind of occupation. So ideally you start investing with whatever you can, but take assistance in the beginning. Now, if you're getting into and venturing into stock market, you do not want your first experience to be a bad one. Now, if you start picking up stocks based on certain information, which you do not, which you probably get it in the form of tips from your friends and colleagues, and if you burn your hands in that, you will never come back to stock market again, and that will be a very, very sour experience. So, I suggest when you start off, understand that your professionalism, your specialization is in the medical field. Stock market, finance, investing are totally different areas altogether. So ideally start on a good note. Even if you get a little less returns, it's fine. But just don't burn your hands so much that you become wary of the entire industry. So mutual fund could be one of the options that you can start with. Start small, start slow with a basket of stocks. Have a good experience, and then probably you could increase it. By the time you'll also start earning enough, which is post 30 and 35.
Dr. Mishra, like I mentioned, was an exception. He's got the core competency of being able to be an astute stock picker. Not everyone may have it, and that's the reason why you have a product like mutual funds, which is not just, for doctors, obviously for everybody, when you don't have the core competency of picking stocks. Now, what do you think is peculiar about the profile of a healthcare worker, Harsh? Yes, equity mutual funds, of course, is advisable, but these workers, at least right now, especially during the pandemic, it's put them in a very precarious position. It's unfortunately they're taking a toll. It's taking a toll on their own health and their lives as well. Do you think that this is at this point of time limiting their ability to take risk?
Not really. So, Mubina, when you look at a healthcare professional, you look at a doctor or a specialized surgeon for that matter, the first thing that you have to understand, the source of income is purely out of the work that they themselves are putting in. So it's not like a business wherein even if one of the executives or the director of the company is not available, the business can run on its own to a sufficient extent. It may not, if it's a key personnel and all those, I'm not getting into that kind of a conversation. But you must understand if a professional, a surgeon or doctor is giving in his own services and then he or she is earning, if anything were to happen to this particular professional, the entire income of the family goes. So I'm driving a point coming to stating very clearly that you have to insure yourself. That is the first step of financial planning. Make sure you have adequate life insurance in the form of a term plan, because if you are not there, your family's the income stops completely. It's not that somebody else takes over. You need to have adequate, a medical insurance. Though you're from the medical field, and many doctors I know whom we advise and whom we are talking to, they believe that, because I'm from a medical fraternity, I will get assistance from fellow doctors. The hospitals will accommodate me. Well, that is good, but why not have a proper medical insurance for yourself? Why depend on your affiliates, your colleagues, and your friends? I mean, that is really not required. So make sure you have adequate insurance. Now coming to the aspect of whether they can take risk. So well, as I said, a doctor's or professional's income would typically start after the age of 30 or 35. Now at that point in time, you will need to invest your money in such a way that you have debt and equity allocation both. Now, if you do not take a combination of both, you're going to miss out on everything. I'm not saying you need to invest everything in equities. I'm not saying you need to invest everything to debt. You need to have a combination of both, because a combination of both will actually help you achieve your goal. Whether you can take more risk, in fact, it's contrary to what usually happens. As you said, there are exceptional cases where they understand equities, but in general, I have seen the medical fraternity being very, very apprehensive about investing in equities. They prefer products like a fixed deposit. They prefer, properties for that matter, because they have lump sums. Another thing that they're very wary about is taking commitment of investment. So, do I have to invest every month? Do I have to invest every year? They don't like that. So, most certainly, they can invest in lump sums, but you need to make sure that you have a balance of equity and debt both. And in fact, I would suggest that they have the potential to take higher risk. So, in fact, they should take higher risk and not be wary of.
Well, I suppose one of the most common reasons for doctors and for others as well to be choosing the more traditional investment classes like fixed deposits is purely because they're unaware of the world of equities, if you could call it that. It's complex, it's volatile, and hence they'd rather go for an instrument that gives them their return in black and white, on pen and paper. But I suppose now it's changing, and more and more do want to invest in the entire Dalal Street story. How do you see, I know you spoke a little bit about asset allocation and the mix, but ordinarily for somebody who's young, I mean, sticking again to the healthcare workers cohort of the population, for somebody who's young, for somebody who's perhaps a little more older, what sort of a mix would you recommend in terms of asset allocation?
Yeah, so Mubina, to begin with, you have mentioned very correctly that, the lack of information of a particular field. So doctors, professionals, these healthcare professionals are very good in their own field. I mean, they're masters in their own field. And, there is also a trust deficiency in the, deficit in this profession. So you will not find doctors trusting anybody outside the fraternity very easily. So, and if somebody is, and there's a very strong word of mouth kind of a reference that goes around within the doctors fraternity particularly. So, one is, of course, you will have to consult, professionals of every field. So if you're a doctor listening to this, you will possibly need to meet and talk to somebody who's a professional in their own field, like you are a professional and expert in your own field, who can guide you as to the nuances of each investment. You need to understand, like every medicine that you give, there could be some side effects. You need to understand the investor and allocate equities accordingly. So a young person who's just starting off with no liabilities may not be very well settled in the career right now, but of course, going further, he or she will be. So you could take an equity exposure, which is probably a little moderate. You don't need to, and this is completely reverse of what we talk to other people. In corporate jobs, we said that when you're young, you need to, have a higher equity exposure. But in a medical fraternity, until you're very well settled, which is around your age of 35 years of age, you should take a little less risk, because your incomes are not that much as another corporate job at that point would be. Once you're very successful and established, which I'm talking about doctors who are like probably 40s, in their 40s and 50s, and by then, I mean, they are renowned names in their field, and the kind of income that they can generate is unlimited. I have seen doctors at that point in time having about 90% of their allocations in equities, and which is a very fair thing to do, because from here on, their income is only going to go up. And once they cross 50, 60, it continues for them. It doesn't stop. There's no retirement in that sense for a doctor. So a medical fraternity, particularly doctors, will have an inverse asset allocation requirement as compared to a corporate job. So this is one, very particular and peculiar characteristics of the frontline workers, stroke doctors and surgeons.
Yeah, exactly. That was going to be my point actually, because doctors don't really have a specific retirement age. They continue to work until they are physically able to, and I think this gives them the freedom as well to choose their own retirement age in a way. Harsh, anything in firstly then, what sort of importance would you give retirement planning for doctors in terms of their financial goals, and any product you think that maybe doctors should stay away from, investment product of course?
Yeah, so Mubina, when talking about the retirement planning for a doctor, well, I would suggest that there are two reasons when a doctor would not essentially be actively involved in practice. One is, of course, because of physical incapability, wherein you've grown older and you don't want to practice anymore. The other is, of course, if there is some changes in the medical field and you were particularly specializing in one particular segment which has now completely undergone a change, when you are in that context not very relevant. So these are the two instances where a doctor would essentially be out of practice. Now, having said that, I believe if a doctor has been successful in his or her 40s and 50s, there is enough money that they can accumulate, which can be put into a high risk product, high growth product rather. Let me rephrase my term to not say risk, but it's a high growth product. Wherein if you very systematically design a portfolio, you can most certainly be in equity, and post retirement use an SWP kind of a thing, or systematically withdraw small bits to meet all your requirements, daily requirements. And we have been doing this for a couple of doctors. So I say this with experience that a well designed portfolio for a doctor who's been reasonably successful in 40s and 50s, going up to 60s and beyond, you can very well have even a 90% portfolio in equities and still do very well for yourself.
All right, well, there you have it. We understand sometimes the doctor as well needs a doctor. I'm talking about a money doctor, and hence it's important that healthcare workers ensure that they don't just stick to a fixed deposit, but build a good relationship with a personal finance planner who'll set their investments in the right wealth creation course as well. Harsh, thank you so much for joining us today on this very special episode of The Money Show. And with that, we'll have to take a very short break, but when we return, we'll be back with our Spend with TMS segment as well. Guess what, folks? From the 1st of July, cars are going to get more expensive. So, an exclusive chat with Hormuz Sarabji, the editor of Autocar India, coming up after this short break.